Hello and welcome to today's edition of Daily Finance Wrap. I'm Mubina Kapasi and this is the show where we get you everything to do with your finances. Firstly, of course, the big stories that have transpired during the day that will directly or indirectly impact your money, the way you budget, and other daily matters with respect to your finances. We talk about investing, taxation management, loan management, as well as insurance. And of course, almost every day at the end of the show, we take on board your questions and queries. So keep writing into us on the comment box right there on this YouTube Live. Let's get kick-started then and discuss what exactly is it that we are going to cover in today's episode. Well, for all the folks watching and staying tuned with financial news, there was a big announcement today coming in from the RBI. So we'll be decoding all the important elements of that announcement, what was announced, what was not announced as well for that matter, and lots of other small things introduced by the Reserve Bank of India that will impact how you conduct your daily transactions. And we'll be decoding this policy and the impact from an investor point of view with a very special guest. Who is that guest and what's the impact going to be? Stay tuned to Daily Finance Wrap. But for now, let's kickstart the show then with the top stories of the day. First up, the Reserve Bank of India-led Monetary Policy Committee on Wednesday retained the repo rate. What exactly is the repo rate? Well, it's essentially the broad interest rate in the economy based on which banks, financial institutions really decide what the interest rate should be, whether you're a borrower or a depositor. So this is something that actually pertains to all of us because in some way or the other, we are transacting with banks and financial institutions out there. Now, this interest rate is yet again unchanged. The average repo rate is 6.5%. But there's more to it. The MPC also decided unanimously to change the withdrawal of accommodation stance to neutral, which means that instead of saying that, look, we are no longer going to cut interest rates, now the RBI is saying that there is a chance that we may just do that, but we are still holding a neutral stance. So it's still possibly one step behind the accommodative stance, which essentially tells us that, hey, look, the RBI will cut interest rates at the first sign. So that, of course, is the key announcement from the RBI. But, honestly, that's not the only take that's come in. There's another very interesting announcement, and that is with respect to NBFCs or non-banking finance companies. There are several out there. These essentially are those companies that are not banks, but still conduct lending operations. You will see them mostly as housing finance companies. Now, the RBI has said that, look, these housing finance companies are growing very well. When I say growth, that means the credit growth. So the number of housing loans, for example, that they may have issued has grown substantially. However, the governor, Shakti Kanta Das, has expressed concerns that this growth is coming without proper administration. So he has asked these NBFCs that you need to review your target-based compensation structures, You need to check your exposure to unsecured loans. You need to emphasize on robust underwriting and monitoring standards. In a way, how this impacts people like you and me is that it's possible that these NBFCs from whom we take loans will now scrutinize any application more carefully. That is something that the RBI governor is advising these NBFCs to do because yes, growth is important for these NBFCs. They do need to give out loans, but they have to do so responsibly. So that's, of course, on the NBFC front. Now, some other good news coming in for those people who use UPI, and that is with respect to UPI Lite transactions. What exactly does that mean? Well, there are certain limits with respect to UPI Lite and UPI 123 Pay transactions. There are monetary limits. These limits have been enhanced. So first up, they have enhanced the per transaction limit in UPI 123 Pay to 10,000 rupees from 5,000 rupees. The UPI Lite wallet has been increased to 5,000 rupees from 2,000 rupees. And the UPI Lite per transaction limit has been increased to 500 rupees from 100 rupees. Now, by the way, what exactly is UPI 123? Well, it's essentially tailored to work with those users who may not be having access to their smartphones or internet connection. So you just have to dial a number, you select your bank, you enter your debit card details, you have to create a UPI pin, and then you can conduct secure transactions without internet access. So it's essentially great for those people, who may not be having very easy internet access. Well, that of course is with respect to UPI. Remember that even earlier, the governor had expanded the UPI transaction limit for certain kind of transactions, like hospital, medicals, and even taxation payments. And a new feature coming in with respect to RTGS and NEFT. These, of course, are your online payments. Now there's going to be, or rather there's proposed to be, a new beneficiary account name lookup facility. This will essentially be to enhance the security of digital transactions that are conducted. Usually when we do a UPI, there is a way that we can verify the name of the person we are sending money to. And sometimes it happens that when we conduct an RTGS or NEFT, the money has gone to the wrong person. So if we are given the facility to verify the recipient's names before completing the fund transfers, the possibility of these erroneous transfers may not happen. So that's why this beneficiary account name lookup facility will be introduced. Definitely a more consumer-friendly one coming in from the RBI. Well, those were all the top stories, and yes, all of them coming in from India's central bank, the Reserve Bank of India. And now let's decode this entire RBI policy, the more important part, and that is the repo rate being unchanged at 6.5%. From an investor point of view, what does it mean? How should we read into it? And what should one expect going forward? I have with me a very special guest, Mr. Sandeep Agarwal, the head of fixed income with Sundaram Mutual. Sandeep, thank you so much for joining us today on Daily Finance Wrap. I think before we really, delve into the details, I'd like you to, just share with all of our viewers what, according to you, were those 3, 4, 5 top highlights that stood out from Mr. Shakti Kanta Das's speech today.
Hello, everyone. Yeah. So today's policy was, I would say, a rather very balanced one, though on the rate side, the outcome was pretty much on the expected line, as in there was no change in the rate. But I think the highlight of the policy was the change in the stance, which in a certain way, a certain section of the market was expecting RBI to do. Though RBI so far has been reluctant, even to change the stance, and market participants have been contemplating, as in, whether the RBI is straight away going to announce a rate cut or they will change their stance. But if you look at, this regime of MPC, they have been very methodical and they have gradually been, easing. So if you look at starting from the FAB policy this year, they have first of all they increased the systematic liquidity in the banking system, which led to reduction in the overnight rates, which in a way impacts how everything is priced in the market, all the debt instruments. And then slowly and steadily, now they have arrived at a decision to change the stance. So what essentially the change in stance means is, one is the plain reading, of course, that now we are neutral and completely data dependent and ready to act. So in a way, what RBI has done is effectively, they have bought themselves some headroom to react, and they have lowered the bar now for any rate action on in terms of lowering the rates. How they have done it so far, RBI has been highlighting that the rate decision is purely based on uh, dynamics of inflation and growth. Add to that, last 2-3 policy, they have added another factor of financial stability, which they have been quite vocal about it. And in fact, one more announcement in the same direction today was the caution towards the unchecked lending by the NBFCs, and that is something RBI is quite cautious about. So now, if you look at by changing the stance, it's another step in the right direction, as in to say, putting the horse ahead of the cart. Now, next action, provided there are no surprises, we believe that RBI is going to announce rate reduction, most likely in the December policy. Maybe what led in terms of stopping RBI in terms of changing the rate this time around in this policy. Reason could be, so many uncertainties around still, despite the fact that the inflation has cooled off quite a bit, and in fact RBI's projection also for next 6 to 12 months ahead is in around 4.5, which is quite close to the RBI target. But I think so far, what has held RBI in terms of announcing cuts is, one is growth is quite robust, and cutting rates at a time can lead to overheating of the economy. So that is something they wanted to avoid. Other factor was the global interest rate environment. So from that perspective, I think the recent action by the central banks in the developed economy, most recently by the US Fed, by cutting the rates by 50 basis points. So that is something, on that side, the concern has been taken care. At the same time, what stopped RBI from going ahead and announcing a rate cut was probably these, geopolitical uncertainties and the higher food prices. So on that front, I think by the December policy, we'll have more clarity in terms of these geopolitical developments, the US elections, and at the same time, how the inflation pans out, given that RBI has increased their third quarter's inflation forecast. So I think more clarity will emerge on these front, and RBI will likely to take a action in terms of reducing the rate, starting with a 25 basis point cut in December meeting.
Okay, so only 2 months later. For most of our viewers watching, there's something very important that they must understand, and that is that how the fixed income market is dependent on the RBI's announcements. And who better than you to really help our viewers understand it? So, as an explainer, could you help them, understand how these two are correlated, and then essentially make sense of all the information you shared with us?
Sure. So how it functions is, in debt market, returns are a combined factor of the carry or the carry yield, which is the interest rate on the debt or investments made by the fund, and the other factor is the capital gains or losses. So any returns in any fixed income funds or fixed income product is a mix of these two. So what happens is, when RBI announces reduction or increase in the policy rate, so that rate is essentially the rate at which the RBI lends to the banks. So that is the overnight rate, that is for 1 day, and that is the base rate at which everything else is priced in the debt market. So when RBI gives the indication in terms of reducing the rates, then everything in the market, starting from 1 day instrument to 1 year, 10 year, 20 year, 30 year, 40 year bonds, everything will start getting priced from the new benchmark provided by the RBI. So what happens is, when RBI reduces the rate on the policy rate front, market will start pricing in all the debt instruments according to the new policy rate. So now what will happen is, the existing debt which has been raised at a certain rate will become more attractive for the investors, and accordingly the prices demand for that will increase, and that will result into rise in the prices, resulting into capital gain. So over and above the carry yield on those instruments, investor will also get the capital appreciation. So that is what it means for the fixed income funds, any change in the rate from the central bank, because that's the source of pricing everything.
Correct. Very well explained. And, essentially, all your fixed income securities are, in a way, priced by what the RBI decides in terms of the repo rate. So, fixed income securities, the most common way, of course, for investors to invest in these securities is via debt mutual funds. So if the value of these fixed income securities, like for example, government securities, bonds, commercial papers, etc., changes, then obviously the NAV of debt mutual funds also changes. So far, Sandeep, we've been looking at very elevated interest rates. So what did we see in terms of what debt mutual funds did? Because for the last 10 sessions, interest rates have been unchanged. And before that, of course, the RBI was rapidly increasing rates from that COVID lows. So we had rates going high. And then for, a whole year almost, or probably more, we had interest rates just flat. So what did that mean for debt mutual fund holders so far?
Sure. So what, as I explained, when RBI was raising the rates, that resulted into existing debt becoming unattractive for the investor, and that resulted into depreciation in the prices of those bonds or securities. So that led to a certain amount of capital losses, which will end up in reducing the investor's return, because that will eat away some part of the carry yield on that instrument. So that is what happened when RBI was raising the rates in line with most of the central banks to cope up the higher inflation by reducing the demand. So that is what happening. Though RBI has been on a status quo for a very long time, but if you look at essentially from last 5 to 6 meetings, after the RBI was done away with the rate hikes, markets have been contemplating a rate action on the downward side from the RBI. And if you look at the bond yields have already dropped quite a bit. So if you look at over the last 6 to 8 months, there is already decent rally has happened in the bonds. So government securities, which were trading around 7.3 10-year bond, is currently trading around 675. So it's almost more than a 50 basis point rally which has happened because of this expectation, in line with the slow and steady reduction in the inflation domestically as well as in the advanced economies. So some bit of that has already taken place in anticipation. As you know, market always tries to price in the future action. So here also, to certain extent, this thing has already been discounted in anticipation. Now, with the clear indication from the RBI that now they are at a neutral stance on the monetary policy rate fronts, and if the environment is conducive, they will be going ahead with the possibility of a rate reduction from the current high rates. Because as we speak, the real rates are very high for quite some time. So, with this increased possibility of rate action from the RBI, I think the prices of the debt instruments will further appreciate from where they are, and that opens up a good opportunity for the investors to invest in the debt instruments to take advantage of current market situation.
Sandeep, do you think that right now, see, the interest rates haven't been cut yet, but there has been a change in stance. But do you think that all of the value of all of these instruments have already, in a way, appreciated? Because more often than not, just like how in the equity markets, we don't wait for the actualization of the news. We just wait for that hint to come, and the market has gone ahead of itself and priced the respective securities accordingly. So is this something that you're already seeing with the bond yields, and then of course consequently the securities as well?
Yeah, so as I said, quite a bit of rate movement has already happened, in anticipation of easing in monetary policy by the central bank. And as RBI moves ahead with the rate reduction, more will come depending upon of course the incoming data and the future scope of rate reduction from the RBI.
All right. Now, of course, in debt mutual funds, the entire umbrella, there are so many different categories. There's long duration, then there's medium duration, short duration, liquid funds. Um, does the way interest rates move impact these different durations differently?
Yes. So essentially, duration is, like we have beta in equities. So duration is a measure of risk in fixed income. So just for an example, let's say any fixed income instrument or a fund having a duration of 1 essentially means if there is a change in the rate by, let's say, 1%, the change in the price of that instrument will also be around 1%. Similarly, let's say if there is a instrument which has a duration of 5 year, and there is a 1% change in the interest rates, then the change in the price of that instrument will be 5%. So that is, roughly the relationship between the duration and the change in the price of the bond. So as you are asking that, what will be the impact on, let's say, a fund in liquid category, or let's say a short duration or a long duration. So essentially what happens is, low duration category, or let's say liquid funds, have a very low duration. So for example, a liquid fund can have a maximum duration of 0.25%. Essentially, if we look at in practice, normally it hovers around zero point 0.1 to zero point 0.2. Normally this is the band. So even let's say, let's pick it on the higher side of zero point 0.2 duration. Let's say if the rates drop by 100 basis point, we'll have a capital gain of 0.2% in the fund NAV, or a fixed income instrument of that maturity, that will get added to the carry yield of that product. Similarly, as we move higher into the duration buckets, the amount of changes in the prices will be higher. So let's say investor investing in a product with around 1 year of duration, and the rates drop by 50 basis points, then over and above the carry, he will have 0.5% gain on the NAV of that product. As we move ahead on a longer duration, let's say a 5 year or a 10-year duration product, the move will be higher. But all this possibility or expectations of higher gain also comes with the higher risk. So let's say for any reason, let's say, because of any big development on the geopolitical situations, if the scenario changes, the global commodity prices move up, or some risks to materialize, then that may not happen, and some bit of prices which has run up because of the expectation can reverse to certain extent. In that scenario, investor will have also have to face the reduction or capital losses, which will reduce their returns from the carry because of the negative change in the prices. So there is a different risk class with each product, and different expectations in terms of returns. So investor should always pick up the investment revenue or a product depending on two things. One is what is their investment horizon, and the other thing is what kind of risk appetite they have, what is their goal. So these two three things investor should keep in mind while deciding the product for investments.
Okay. Understood. So, just your overall take now. I mean, you've told us about how the different duration mutual funds move based on interest rates, and yeah, goes without saying that every investor must consider their goals, their risk appetite before choosing. From the different mutual fund products that are available. But if you just had to share some strategy to all of the debt fund holders watching, that from your own, is there a certain duration of funds that they should perhaps consider adding to their portfolio?
Sure. So we believe that the current interest rate cycle, cut rate cycle is going to be a shallow one, wherein we expect RBI to reduce the current policy rate by 50 to 100 basis points. And in line with that, we believe that already some bit of price action has already happened in anticipation of these moves. We believe that short to mid duration product are the most suited for most of the investors on a risk reward basis. However, as I said, investor should pick up the product depending on what kind of investment horizon they have and what kind of risk appetite they have. So, for example, somebody looking to invest only for, let's say, a period of 15 days to 1 month, should not venture into the product with duration of a 2 year or 3 year. Rather, they should stick to categories like liquid or ultra short category. However, at the same time, investors, who have an investment horizon of, let's say, 1 year plus and have some risk appetite, can look for products in the mid duration, the short to mid duration product, that is 2 to 4 year duration kind of a product, wherein not only they will have the higher carry yield, at the same time there is a good possibility of having extra returns in terms of capital gains as and when the RBI starts reducing the rates.
All right, understood. Okay, I think that was a very comprehensive review of the RBI policy and the impact that the announcements have on our day-to-day lives, on our investment portfolio. In fact, more importantly, we also take on board some viewer questions and queries, and we've got quite a few of them right here on our YouTube live chat. So, Sandeep, I just want to take on a couple of them while you've answered quite a few. Ashish Thakur is asking a very interesting question. Can you please tell me how the RBI's policy affects returns on corporate bond funds?
Sure. So as I said, any fixed income fund returns are consisting of two factors. One is the carry yield, which is the coupon that the fund received on all the investments that they have made. And apart from that, if there is a change in the interest rates in the markets, that will impact the prices of the bonds that are being held in that fund. So accordingly, there will be capital gains or losses. In the current environment, wherein we are expecting a benign interest rate scenario and expecting RBI to cut rates, there is a possibility that the prices of these bonds will run up higher from what they are today. So that will also add some bit of capital gains to these products. So as an example, as I just explained, let's assume that rates from wherever they fall by, let's say, another 50 basis points. And I'm assuming that you are investing in a corporate bond fund which has a duration of, let's say, around 4 years. So what essentially it will mean is that you will have around roughly around 2% of capital gain over and above the carry yield of that product. So in the simplistic terms, this is how you can look at what kind of returns can come in looking at the duration of the product. And the impact is only on the prices, which will change the capital gains or losses.
Okay, understood. Um, Akash Kotian is asking a question. If interest rates are expected to stay the same, should I be looking at long term or short term debt funds? Now, I know you briefly, answered this question in your previous answers, but just for the benefit of, our viewers who may be tuning in right now, if you could summarize.
Sure. So as I said, first thing you need to, whenever you are making investment into any debt fund, or rather I would say any investment, first thing you need to look at what is the end goal out of that investment. So let's say if you are looking for, let's say, a retirement objective wherein you want to invest is for, let's say, 15, 20, 30 years. So in that kind of a scenario, definitely, one should look at long duration product, given that, our economy size is, consistently growing, and it's reaching a stage wherein, the economy will stabilize. We won't have, because India has traditionally been a supply constrained economy, and we are, getting over with that kind of a thing, as we are growing. So in that kind of a scenario, we will have a more stable regime from the inflation perspective. And as and when that happens, the premiums will also, go down compared to what they are prevailing today. So in that kind of a scenario, we will also start behaving like, other developed economies wherein, inflation would be lower. And uh, also you will have lower rates from the long term perspective. So from that perspective, let's say if currently, a 10-year 20-year bond is available at close to 7%, that may start trading at much lower yield. So from that perspective, yes, very long duration. However, if you are looking for a shorter investment scenario, then as I said, you can look for any short to medium duration product. And if it is a very short investment horizon you're looking at, then you should stick to products within the money market or liquid category fund.
Understood. All right. Well, I think that's all the time we have to take on viewer questions. But before I let you go, Sandeep, today is incidentally World Financial Planning Day. So, just some words of wisdom from you to all of our viewers on why financial planning is so crucial before you actually even start off on the journey of investing.
Definitely, like anything else in life, when you start something without planning it, then however, best you analyze the situation or investment product, you are bound to make mistakes. So that's the first thing, you need to assess what is the requirement that you will have. And I think a lot of good amount should go into that before, because let's say if you have not analyzed what is your requirement, then you don't know actually what is your goal is. So starting a race without knowing where it will end. So like if you are running a marathon, you should not be running too fast at the start itself. You should look at the steady space, speed. So like this is for investments as well. First thing you need to focus is what is your goal, what is that you want to achieve. If your goal is to be achieved by, let's say, a return of, let's say, close to 15%, 12%, 13%, then it's unlikely you are going to achieve it out of a fixed income product, until unless you take extraordinary risk. So in that kind of a situation, you should look for an equity product or alternative investments wherein you can have higher returns. Similarly, if your objective is not rate objective is not that high, but at the same time safety is paramount, then you should pick up a fixed income strategy with lower risk. So first you need to know what is your hurdle rate before you decide on investments. No point of discussing or analyzing which one would be the best. First you need to define what is your goal and what investment strategy can achieve you that goal. Then probably you should look for what will be the best product within that category.
Very true. Sandeep, I hope that all of our viewers watching take in your advice. Thank you so very much for joining us today in what I'm sure has been a busy day for you, decoding the RBI's policy, and hope you have a lovely day.
Thanks, Bobina. Thanks, all the viewers.
Okay, well, that of course. She's in a rush too. Again, I had, last time also. She played this thing.